The goal of investing is to make your money work for you so you no longer have to work for money. The stock market is one of the best ways to build long-term wealth, but only 56% of the US are investing in it. Most people don't invest because they believe you need to be wealthy to start, or they're just paralyzed by fear. And if you've ever spent hours researching the perfect fund and you're terrified of picking the wrong investment, you are not alone. I remember my first few $1,000s I put into the market, and I did the exact same thing. But here's what I learned. Just getting into the stock market and getting your money working for you is better than waiting for that perfect moment. Getting started today is easier and more accessible than it's ever been, and by the end of this video, you will be ready to start investing. Hi, my name is Clark, and I'm going to help you learn the basics to get on your way to financial freedom. Before we dive into investing, there's one critical step you need to take first. Build that emergency fund. I highly recommend 3 to 6 months of expenses saved in a high yields savings account before you start investing. This ensures that if any unexpected expenses come up, you won't be forced to sell your investments at a bad time. Once you have that safety net in place, you are ready to go. The first thing that we need to learn about is compound interest and how powerful it actually is. Compound interest is the interest you earn on your interest, often considered the 8th wonder of the world. To make things simple, let's say we invested $100 and the interest rate was 7% annually. After 1 year, we would have $107. Then year 2, you would earn 7% on your $107, and you would end up with $114.49. I know these numbers don't seem big, but as you can see, the first year you earn $7 and the second year you earn $7.49. I like to think about this like rolling a snowball down a hill. It will start out very small, and each rotation it gains a little bit of snow and gets a little bigger, and as it grows, it collects more and more snow every rotation, and pretty soon it becomes a very large, unstoppable snowball. If we look at a long timeline of 30 years, which is pretty standard for a retirement account, we will really see how this works. Let's say we invest $6,000 per year for 30 years into a mutual fund that follows the total stock market, which would grow at an average yearly growth of 7%, which is the average growth adjusted for inflation over the past 50 years. Since this is adjusted for inflation, this allows us to see our buying power in today's money. At the end of that 30-year period, you would have invested $180,000 of your own money, but your account has grown to over $566,000. That means $386,000 was all due to compound interest. And if we do this for an even longer period of 40 years, you would have invested $240,000, but the account would have grown to almost $1.2 million. That means your account would have grown $957,000 all by itself. You can see how once you get the ball rolling, it begins doing the work for you. The snowball will build up speed over time and become a machine that is making you money at all times of the day. And the earlier you can start investing, the more time this compound interest has to work and make you more money. And your money just keeps growing. This is why, if possible, you should start investing as soon as you can, even if it's only small amounts. Now that we understand the real power of compound interest, let's talk about where you actually invest. A brokerage company is where we can open an account to have access to buy and sell stocks. Some examples of brokerage companies are Fidelity, Vanguard, and Charles Schwab. Within the brokerage, they can offer many different types of accounts, such as your 401k, IRA, Roth IRAs, HSAs, and taxable accounts. Within each of these different types of accounts is where we can invest in different stocks and funds. The 401k, the IRA, the Roth IRA, and HSA are all tax-advantaged accounts. If you want more information on these specific accounts and what order I recommend investing in, check out the video I made on optimized order for investing in the description below. Now, let's talk about what you can actually invest in. There are multiple ways you can invest in the market today: mutual funds, ETFs, index funds, and stocks. A mutual fund is an actively managed fund that contains a basket of stocks that are trying to beat a very specific benchmark. The S&P 500 and total stock market are examples of benchmarks. Since mutual funds are actively managed, they will usually have higher expense ratios. The expense ratio is an annual fee expressed as a percentage of your investment. If the fund has an expense ratio of 0.5%, then for every $1,000 you have invested, you pay $5 a year. An index fund is a passively managed fund. This is trying to match the returns of a certain basket of stocks. These funds usually have very low expense ratios. So the difference here is the mutual fund is actively managed and is trying to beat the market, while the index fund is passively managed and trying to match the market. Both these mutual funds and index funds can only be bought and sold once per day. An ETF is very similar to mutual funds and index funds in that they contain a basket of stocks tracking a specific benchmark, but the main difference is an ETF can be sold and bought any time of the day, which makes it better if you are more of an active trader. Lastly, you can invest in individual stocks. With stocks, you will not be paying an expense ratio, but depending on what brokerage you invest in, there may be a small fee for selling stocks, usually between $3 to $7. But there are many brokerages that offer commission-free trading. If you are just starting out, it is a great idea to invest in an index fund or ETF that follows the total stock market or S&P 500. VOO or VOO is Vanguard's S&P 500 fund, and VTI is Vanguard's total stock market fund. The other brokerages will have very similar funds that you can invest in and track the same indexes. Buying one of these funds gives you instant exposure to hundreds or even thousands of companies, and they will also have a very low expense ratio. VOO, which is Vanguard's S&P 500 fund, has an expense ratio of just 0.03%, which means you will only pay 30 cents per year for every $1,000 invested. Being diversified is a great way to hedge your risk against a single company going under. If you were to invest in individual stocks, you would need substantially more money to be diversified. Some stocks can be hundreds or even thousands of dollars to purchase just one share, but you can invest $1,000 in VOO and have a small percentage invested in Google along with many other top tech companies. I have the majority of my net worth in index funds and ETFs. I continue to invest in them because I feel they are the easiest way to be diversified and get the same returns as the market without having to do all the research of individual companies. If you take a look at actively managed funds, you will find that over 90% of them fail to outperform the market over a 15-year period. I figure if the experts who do this for a living can't beat the market, then I'm probably not going to be able to do that either. Next, let's talk about an important investing strategy called dollar cost averaging. This means investing a set amount of money on a regular schedule, whether that's weekly, bi-weekly, or monthly, regardless of what the market is doing. Maybe you invest $200 every 2 weeks when you get paid. This strategy is powerful because you will buy when prices are high and sometimes when they're low, but over time it averages out. The key is to stay consistent and keep investing even when the market is down. And here's something crucial. When the market drops, don't panic and sell. Market downturns are normal and have always been temporary. In fact, downturns are opportunities to buy more shares at a lower price. The stock market has always recovered and reached new highs over the long run. Of course, it's very important to remember that past performance doesn't guarantee future results, but historically, if you look over any 20-year period of time, the market has always increased in value and has helped many people build wealth. There are 3 key things you need to know about yourself before you start investing. First, understand your goals and timelines. If you're investing for retirement in 30 years, you can afford to ride out the market's ups and downs because you have time to recover. But if you're saving for a house down payment in the next 5 years, you need to be more conservative and save money in a high yield saving account because you can't afford a big drop right before you need that money. Your timeline directly affects how much risk you take. Second, know your risk tolerance. Some people can watch their account drop 20% during a market downturn and stay super calm, trusting that it's gonna recover. Other people are gonna lose sleep over these swings and will be tempted to sell at the worst time. Being honest about how you handle volatility helps you choose the right investment mix so you don't panic and make emotional decisions. Some investors enjoy spending hours researching individual companies and actively managing their portfolios. Others prefer to set it and forget it with index funds that require minimal maintenance. Neither approach is wrong, it's about what fits your lifestyle and how much time you want to dedicate. I feel like most people would benefit from just buying index funds. Knowing these three things will help determine how and where you invest your money. The longer your timeline, the more risk you can take, and depending on how involved you want to be, you can choose between actively researching individual stocks or passively investing in index funds. For me personally, I invest in index funds and let my portfolio follow the market without consistently monitoring it, and I have had great success building up my portfolio doing this. With all that said, I hope I gave you enough information to start your investing journey. If you found this helpful, do me a big favor and tap that like and subscribe button. I hope you have a great day, and I'll see you in the next one.